You're watching Stockwatch. Well, this week with me, Ray White. Joining me to unpack your stock-related questions today via Zoom is Rowan Williams from Nitrogen Fund Managers. Be sure to send your question through, though, via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X @BusinessDayTV using the hashtag Stockwatch. Rowan, good to chat to you on Stockwatch today. One of the big stories has been Cell C. And I'm looking at the computer and quite a few people wanting to know your view on Cell C. The results came out today. I was a little bit worried. I don't think I need to be worried anymore. I think they've done pretty well since listing. What are your thoughts?
Yeah, so the newest company on the JSE, as you mentioned, they listed late last year. So a bit tricky to get the actual listing off. I think the market was a little bit skeptical. Cell C has sort of had a spotty track record. They've had to recapitalize. And the group has also been formed by a merge of an equipment company that's part of the broader group as well. So I think the results were sort of keenly anticipated. The sort of numbers, I guess, top line is kind of muted. The prepaid numbers were reasonable. I think sort of a bit of a kicker is the wholesale business. They're moving into a capital-light model and trying to get traction in the MVNO space. And I guess we've seen the results of Capitec Connect, which have been quite strong. So they will be a beneficiary of that. So overall, the results did look decent. And I think the sort of investment case, as they sort of laid it out, looks like it's intact. So it's still a work in progress. The EBITDA numbers weren't sort of as exciting as the turnover numbers, which are slightly better than their peers. So I think overall, yes, they're moving in the right direction. And I think it's one to watch and maybe, I guess, on weakness to pick up at this sort of level around the 30 Rand mark. I think it's sort of accurately reflecting sort of the prospects. But if the MVNO model does work and we see continued traction there, we could see the numbers move higher. So, yeah, I think it's sort of wait and see.
Yeah, it's actually quite interesting that you say that. I mean, if you get in now, I don't know, I suppose you could do well with the stock. You really could. You need to see the second half of the year. You need to see what's happening. But they certainly are, I think, laying a very good foundation.
Yes, correct. So they are doing sort of what they set out to do in their sort of listing. And what I guess you need to see is sort of the strategy come through and then also translate into earnings, essentially. So if that is the case, I think you'd say, yeah, the business model and the strategy is working. The investment case does hold water, and there would probably be an opportunity still to enter. So, but if you like the story, I think it is a credible management team. You could say, yeah, this looks attractive here, but we're sort of taking a little bit of a wait and see approach for now.
Yeah. Right, here we go. A question from Yanis. He says, ask your guest, I'm confused about BAT. They're withdrawing from our country, he says, yet they're concentrating on other areas. What's the bottom line with BAT? And I can see their stock today was up.
Yeah, so they have actually been executing really well. It is a very defensive stock. You know, it's got nothing to do with, say, technology or AI. And really what we're seeing is smoking has been more defensive than anticipated and being able to push through price increases, even though volumes are coming down. I think the big kicker is really in the next generation products, really the sort of smokeless tobacco products. And they are getting traction there. Sort of it hasn't been as strong as some of their other peers. But overall, they're really delivering, I guess, against expectations. And it is a strong cash-generating business. They have been embarking on a buyback program, which has been successful, and continuing to pay down debt. So I think what we need to see from here is continued traction of the NGP space, the smokeless products, which they are a little bit behind. But if that does continue to grow market share and grow revenue, I think the defensive nature of it remains. It's a strong dividend payer, so a good compounder. So I think, yeah, there's reason to still like it, and it's a rand hedge. And yeah, the rand has strengthened a lot, but I guess it looks more evenly balanced at these levels.
Oh, interesting. Very interesting. All right. A question from Jan or Jan, I'm not sure. From Alphabet to Microsoft. I'm confused, says Jan, when it comes to investing in big tech. Now, last night, you saw this sell-off last night. Apple losing 5% at 1.200 billion on the line, evaporating there. Things seem to be very volatile when it comes to big tech and AI. What are your thoughts?
Yeah, so I think two things. The share prices have run really hard and they are very high. So a lot of expectations are baked into the share prices. And then that's at a point when I think the sort of forecast horizon is becoming more uncertain because the AI story is played out and it's been discounted. But what is the actual impact going to be on these companies? They are investing significant amounts of capital. We're talking multiple hundreds of billions of dollars in the sort of AI tech stack. And we're not sure what that payoff is going to look like, who the winners and losers are going to be. Are they ultimately going to get a return on capital? So they have the capital available, but they are deploying it. Depreciation charges are going to go up. The sort of capital light models that we've seen are changing to sort of more capital intensive. So our view is they look rather full, and I guess as expectations changes about what the future looks like, so the shares will be volatile. We think they will remain quite volatile as the sort of future plays out, and we think it is an opportunity to potentially, if you've done well and run with them, to rotate into other more defensive sectors, other sectors. You do have to look, though. There's also been a big tech sell-off of sort of enterprise software providers that also there's concerns what AI is going to do to their business model. So you have to think quite hard about deploying your money in the tech space right now.
Rowan, is there a bubble here? Is there a massive bubble that's going to go bang? Or is it just people recapitalizing with AI? I mean, I think it's such a difficult question to answer, but I'm going to ask you anyway.
It's quite hard to call because this is a transformational technology. I think in terms of the size and quantum of investment versus the expected returns, for me, there's a mismatch, which means the pace of sort of purchasing of semiconductors will come down, which means, yeah, it does look like some of these stocks, I think they're baking in too much about continued growth at these levels of continued earnings, even in cash flows at the current demand levels. So that would imply that, yeah, the shares are expensive. Bubble's a strong word, but, if sort of expectations change a little bit, the shares can come off quite significantly. So I think it is finely balanced. Yeah. And, I would be somewhat concerned right now.
Right, another Stockwatch question is from Anonymous. I'm confused when it comes to PGM and gold producers. Which resource stocks are a sure thing for the future? I think it's like the bubble question. Which resource stocks are? I mean, you've seen quite a few of our miners doing really well. We've had trading statements lately showing great progress, but again, it's our gold price.
Yeah, absolutely. So the precious metals have run really hard, and as a result, the precious metal miners have run really hard. And the cash flows are there. They're translating those into actual profits. I think what you're seeing was obviously these miners, there's a lot of operational leverage against the precious metal price. Given that the prices have moved up so much, there's less operational leverage. Speaking to some analysts, they feel you could be safer in the actual metals than the miners themselves. You sort of get exposure to the price movement without operational risk and execution here, and the potential, I guess, that some of these miners spend their kind of windfall profits on other acquisitions, development rights at the top of the cycle. I think a safer way to play sort of this commodity run would be diversified miners. I think the underlying demand drivers for something like copper and other base metals remain good. Transition metals, continued electrification, EV spending, and that's sort of been the swing, I guess, in terms of away from so the precious metals towards that, away from, say, copper and EV. But I think it'll balance itself out, and the demand drivers for me are more intact there and less volatile.
Yeah.
And so you get a diversified basket. Here you're taking more of a view on a precious metal if you buy a gold or platinum miner. So for me, the diversified miners are a better way to play it.
Nice. Diversified miners it is. Question from Tandeka. Netflix has been flexing, Tandeka says. What are your thoughts on Netflix? I mean, I think they've got this whole big deal that they've kind of concluded. Are they flexing?
Yeah, look, it is an incredible asset, and it's an incredible franchise. And they have sort of I guess, won the sort of market share war of the streaming war. So you've got other players and interlopers trying to sort of also get in, and maybe you'll have a few streaming subscriptions as a consumer, but Netflix is going to be one of them. So I think they will continue to win. They have a huge market share. They have a huge subscriber base. Then they're able to take those cash flows, reinvest it in content, buy more content in terms of this Warner Brothers Discovery transaction. And so I think they remain very relevant. And so it is one of those stocks I think that you can buy and hold, because it has sort of, I think, multiple runways, and they will continue to sort of tweak their business model, add advertising, increase pricing, and have a lot of power. So it's a good compounder.
It's a good one. There we go, Tandeka. I hope that helps you. Right, Rowan, your stock pick in a nutshell. What are you looking at?
So we like Process here. We've spoken about the tech space. There has been quite a big sell-off. Tencent have sold off a lot. Process has followed, and the discount to net asset value has widened sort of to the wider end of the band. We still think the underlying assets have very strong market positions, very strong potential. The new management team is focused on shareholder value. The buybacks continue, and we see sort of a 5-year value realization plan and unlock. So you get the double whammy of share price performance and discount unlock, and the combination of those, will lead to good multiple-year returns in the sort of investment horizon.
Sure, Process it is, Nuspass as well. Rowan, thank you so much. Good to chat to you on Business Lunch. I do appreciate you taking the time, and have a good Valentine's Day as well this morning. Thanks for chatting to us on Stockwatch.
Sure.
Thanks to my guest, Rowan Williams from Nitrogen Fund Managers. So do remember that Stockwatch pre-records on a Monday and a Wednesday at 1 p.m. and is live at 6:30 p.m. on a Tuesday and a Thursday, while Stockwatch this week is live at 12:30 p.m. on a Friday. Keep that in mind and keep your questions coming, you see. For now, that's all from Stockwatch this week, but do stay tuned for lots more coming up right here on Business Day TV.